Some analysts have highlighted that one detail that appears to have slipped by unnoticed in the past is the complete lack of focus on the East African Community Common Market. And we've heard talk of the possible eventuality of seeing East African taxes being harmonized so that all member countries can enjoy the benefits and what that spells for investment and trade within the East African region. To what extent has this fallen short of your expectations?
Well, I think it's very important to keep in mind that up until 1966, taxes in East Africa were actually administered out of Nairobi. And up until the demise of the community in 1974, the East African community actually was a community which existed until then. Mm-hmm. We actually had a uniform tax rate, and it was, again, uniform in all three countries. So we're coming from a common background. At one stage, the top rate of income tax here in Kenya was 70%. Subsequently, it's come down. At one stage in Tanzania and Uganda, they had a 30% top rate of income tax, whereas we in Kenya had a top rate of 35%. It's now been harmonized. So although we could say that there isn't a lot of concentration on the harmonization process, as far as customs and excise is concerned, there is quite a lot. In fact, the fact that the common export tariff of 0% on rice, mm-hmm. that actually was agreed by all of the ministers in East Africa in May this year. So you can see that, you know, they actually have a meeting a month before the budgets are presented in the various countries. So although you could argue that there isn't enough harmonization, in fact, we're moving gradually to a greater degree of harmonization. I think there's a lot that could be done. The free movement of people is still not one of those things that is actually on the ground, although the presidents of the various countries have actually spoken about that. But the fact is, they do meet, they do actually agree on common policy, and the tax systems in Uganda, Tanzania, and Kenya are very, very similar, having come from that common background in the past.
Well, of course, it's going to be, it's going to take some time for the system to evolve even further. As you say, there's still a lot more that can be done, and a matter of time before we see that unfold. In the meantime, there's, while we've had this feeling of being overtaxed, emphasized at this stage of the game, it was further suggested that we need to start seeing more tax incentives being created for SME growth specifically, and expansion further into the East African community for businesses that operate on a smaller scale. Your analysis on that front?
Well, I think certainly we could have more tax incentives in that area. One thing I think we have to keep in mind is that up until very, very recently, Kenya in some ways was discriminated against by Tanzania and Uganda. We have, if for example people are importing goods from Uganda into Kenya, there is no tariff whatsoever. And that zero tariff barrier has been in existence, except Tanzania said, well, look, we need a little bit of time before we actually have a zero tariff barrier for imports from Kenya into Tanzania, and similarly into Uganda. But we're moving towards that. I think, wherever you go in the East African community, you will find Kenyans everywhere. They're in Rwanda, they're probably not in Burundi because it's French speaking and it's a very laid back economy. But in Uganda, Tanzania, and also Rwanda, you will find a very large number of Kenyans who've moved there and who are doing business there in small and medium-sized enterprises. Those are very friendly countries as far as Kenya is concerned, really. It's very much easier to do business for example, in Rwanda. I was giving some lectures to the Institute of Certified Public Accountants of Rwanda a week ago. I was in Kigali, a very, very, open place to do business. But the majority of the members of the Institute of Certified Public Accountants of Rwanda are actually Kenyans. So, small and medium-sized enterprises, it's quite easy to get into, there's all sorts of, for example, vegetables. People are exporting vegetables from one country to another now very much more easily than was the case in the past. Looking at it from, let's say, a big business point of view, sometimes it's a little bit more difficult to do business there. But one of the largest supermarket chains in Kenya, it's got a supermarket in Kigali in Rwanda, it's got a supermarket in Kampala in Uganda. So I would say that, you know, it's very much more easy to do business in those countries than was the case in the past.
Of course, a lot of emphasis being placed on, you know, the need to ease tax regimes, but to bear in mind is that we've got governments that need to raise revenue as well. And with that, let's hone in on Kenya, because we're standing with the country holding a deficit of 7.4% of GDP. What are you making of the country's ability, Kenya specifically, of being able to fund that deficit moving forward?
Well, I think we have a real problem there, actually. If you actually look at our Treasury bill rates at the beginning of the year, the 91-day Treasury bill rate was 2.4%. And we have also a 182-day Treasury bill that was 2.675%. Now, up until the beginning of May this year, rates were very low. At the beginning of May, the 91-day Treasury bill rate was in fact 4.0%. The 182-day Treasury bill rate was in fact lower. It was lower at 3.69%. But over the last month and the last 2 weeks especially, this Monday's, that is 3 days ago now, the 91-day bill rate has actually risen to almost 8.8%, just a fraction off 8.8%. And the 182-day bill rate has actually gone to 9.949, almost 9.95%. So it's going to cost the government a lot of money to finance the deficit. A year ago, we were thinking that we were going to, in Kenya, get about 35 million Kenya shillings. Yeah. That's about $500,000 from our donors. As it turned out, we actually got $1.5 billion from our donors. And I think it's with the same optimism that Uhuru Kenyatta, the Minister of Finance, actually said that they're going to get that funding from abroad.
Well, it's going to be a tough feat and something that we'll certainly be keeping our eye on, Jim. Unfortunately, we're going to have to leave that conversation there for today.